Well, welcome to my YouTube channel. This is David Fisher from Landmark Capital. Wow, the markets are in turmoil today on Monday, June 13th. It's the fifth largest sell-off in history. Stocks are down, bonds are down, Bitcoin's down, gold is down. Why the big downward pressure? Well, it's all because of the Fed and the inflationary number. Let's take a look back at history. Last week, Thursday, the Dow was off 600 points. Friday, the Dow was down 876 points. And today, the Dow down 800 plus points. So that's over 2,300 points in the last 3 days. In the last 9 weeks out of 10, the S&P is down, the NASDAQ is down. The last 9 out of 10 weeks, the Dow is closed down. So we're in market turmoil. The CPI number came out on Friday. The Consumer Price Index number came in at 8.6%, which means the cost of goods has risen 8.6% from a year ago. The Economist, according to Bumbers, Reuters, and the Wall Street Journal, was saying that the market, or the CPI number, was going to actually be down. Inflation was going to come down. Many predicted that it would be under 8%, but it was actually up from 8.3% up to 8.6%. So because of that, markets are in turmoil. The Fed is going to raise rates this week, Wednesday. Many are saying they're going to stick to what the Fed plan was, which is in June, 50 basis points. In July, another 50 basis points. But now some are saying they could surprise the market with a 75 or maybe a 1% increase. And some are saying we might have another extra increase in September. All said, there could be 10 more rate hikes between now and the end of the year by the Federal Reserve. The stock market doesn't like this. It doesn't like surprises either, and hopefully the Fed won't surprise the market. But let's take a look at the markets year to date. The Dow is down 16% year to date. The NASDAQ is down 31.5% year to date, and the S&P 500 is down 21%. Mike Wilson is suggesting that we're going to continue to have lower numbers. He's with Morgan Stanley, the chief strategist. But Goldman Sachs is saying worst case than he is saying, and they're saying at the S&P to go down to 3150. That's another 20% down from where we're at. That means that the S&P would be down 40%. I've said year to date. I've said on national radio this year that this is not a dot-com bubble bursting. This is not a 2008 market bursting. What this is the bubble is letting slowly the air out. And we're going to be in a long, protracted environment where markets are going to recede. Why is all this happening? Well, it's really simple. Think of bowling for a second. Have you ever gone bowling? I think the last time I went bowling was 10 years ago or so. But remember, and much younger when I was in my teens or lower teens, in my under 10, when I went bowling, they had these things called the bumpers that they roll in so that you couldn't get in the gutter on the left side or the right hand side. And I'm going to liken this under the Federal Reserve. So the Fed has accommodated the economy. What do? They put the bumpers in so the economy can't go in the gutter, either the left side or the right side. They accommodated the economy. They accommodated the stock market. They accommodated low interest rates and spurred on a real estate market boom. And they accommodated gold going up, all from the year 2009 until now. And they bought trillions of dollars. How much? $9 trillion is on their balance sheet. It was only $1 trillion in 2008. So $8 trillion plus of government spending, of Fed printing, that's all been put into the economy. They put the bumpers in so we would not have a bad environment. Well, in December, it all changed. The Fed took away the bumpers, at least they made the announcement, and then last month, they started actually doing what they said they were going to do when they said this back in December. They started to sell US dollars, sell treasuries, in other words. They started to raise interest rates to try and get to normal, because we've been in this unnormal interest rate environment of 1/4 of a point. So they started raising rates last month. They're going to raise it here on Wednesday, probably 50 basis points. They're going to raise it in July. So where we're going with all this is now, it's like the tide. The tide went out, now the tide's coming in. So the Fed has changed course. They've taken away the bumpers. Now, what is the support of the economy, the support of the government spending, and the environment because of the Fed? It is drastically changing the environment. So where are we headed? Well, let's look at what World Bank said. David Malpass, he's the president of World Bank, the largest bank in the world, and the bank that's most connected to all global economies. He said last week that we're headed for a bad environment. Recession is bad, but something that is even worse than recession is stagflation. What is stagflation? That's when asset prices are increasing while incomes are depreciating. This creates an environment that is severe, according to David Malpass, and Robobank also said the same thing today on Monday. What does that mean for us? Well, stagflation, which we have not seen since the 70s, what happened then? The Dow collapsed 50%, and they call it the lost decade of investing. Interest rates were going up, oil was going up, gold and silver was the number one asset class. Kind of sounds familiar, doesn't it? We just haven't seen it yet in gold and silver, but get ready. That's where we're going. Let's talk to a couple people, or quote them. Mark Axel, who is a big economist, and he says that we're going to see gold as the tool to be your safety net. He says it stabilizes the portfolio. Well, let's take a look at it, see if he was right. If the Dow is down 16%, the S&P's down 21%, the Nasdaq's down over 30%, and gold is up 2.5%, while the dollar is up 8.5%. Gold did exactly what he said it should do. It stabilizes your portfolio. That's why you don't want to have all your money in any one asset class. So back to stagflation. If we have stagflation, and there's many indicators now that saying we're going to be either on the left side of the bowling alley, inflation, or the right side of the bowling alley, stagflation, and it looks now more like stagflation. That's going to be the most worst environment for stocks history, not a very good environment for real estate, and the best environment for gold and silver. So I encourage you to call my company. The number's there below. Get some information. Learn why a well-diversified portfolio in both precious metals might save yourself from a huge heartache, a grief. If you like what you're hearing, make sure you hit the subscribe button and give us a thumbs up. Until next time, tune in. I'm going to be giving some more economic updates. This is David Fisher from Landmark Capital.